Welcome everyone. Today we are going to explore something exciting. We are diving into the volume profile indicator in RTrader Pro. Now this tool is really powerful. It helps you understand where the most trading activity is happening at different price levels. By the time we are done here, you will know how to set it up, read it, and use it to enhance your trading strategy. Stick around because what you are going to learn today could make a big difference in your trading. Are you ready to discover a tool that could completely change the way you understand market behavior? Imagine being able to pinpoint the exact price levels where traders are piling in, and knowing why these levels are crucial to price movement. That is where the volume profile indicator comes in. So, what exactly is the volume profile indicator? I will break it down simply. The volume profile indicator is a tool that shows how much trading has happened at different price levels over a certain period of time. Now, most traditional volume indicators show volume over time. But the volume profile does something different. It shows volume along the price scale. This means you can see exactly where the most buying and selling has happened at certain prices. These key levels often act as support or resistance, and understanding them can give you an edge in your trading. Now, let us expand on this by talking about chart patterns that work well with the volume profile indicator. One common pattern is the *** double top or double bottom ** formation. When you see a double top, it means the price has reached a certain level twice but could not break above it. This usually happens near high volume nodes, which act as strong resistance. If the price starts dropping after hitting the double top, it can indicate a reversal. The double top often has a middle peak, which creates a resistance line. This line is important as breaking below it confirms the reversal, and traders look for confirmation with declining volume. Conversely, a double bottom forms when the price hits a low level twice, but cannot break below it. This usually happens at a high volume node that acts as strong support. The double bottom pattern resembles a W shape, and once the price moves back up through the neckline, which is the resistance between the two bottoms, it typically signals the start of a new uptrend. When the price starts moving up from this level, it is often a signal to buy, especially if accompanied by increasing volume, as it indicates strong buying pressure. In both cases, the volume profile helps identify the volume distribution along these key price levels. High volume nodes represent areas of strong interest from both buyers and sellers, making them crucial points for reversal confirmation. Using volume profile in conjunction with these patterns can help pinpoint entry points and validate whether a pattern is likely to succeed based on the strength of trading activity. Another pattern to look for is the ** head and shoulders ** pattern. This formation is a reversal pattern that occurs after a trend has been established. The head and shoulders pattern consists of 3 peaks. The middle peak is the highest, called the head, and the 2 smaller peaks on either side are the shoulders. When you combine this with volume profile, you can look for areas where the right shoulder aligns with a high volume node, which often signals strong resistance and a potential reversal point. When the price breaks the neckline of this pattern, especially through a low volume node, it can mean the beginning of a strong move downwards. We also have the ** flag and pennant ** patterns, which represent a period of consolidation after a big move. These patterns are formed when the price makes a sharp move, known as the flagpole, and then pauses, creating either a rectangular flag pattern or a small symmetrical triangle called a pennant. Flags tend to have parallel support and resistance lines, while pennants converge towards an apex. These consolidation patterns indicate that the market is taking a breather before potentially continuing in the direction of the original move. When using the volume profile, these consolidation areas typically exhibit lower volume compared to the sharp move that preceded them. This lower volume suggests that the market is consolidating and that there is a temporary balance between buyers and sellers. During these phases, you want to focus on the low volume nodes, which often indicate areas of reduced resistance. When the price finally breaks out of the flag or pennant, it is often accompanied by a surge in volume as the market resumes its initial direction. To identify high probability breakout points, look at the transition from low volume to high volume areas. If the price breaks above or below the consolidation zone and the breakout coincides with the transition into a high volume node, it usually signals that the market has decided on a direction. Flags and pennants are particularly powerful when they occur within a well-defined trend, as they often serve as continuation patterns, providing an opportunity for traders to join the existing trend with strong confirmation from the volume profile. The length of the flagpole can also help set price targets for these patterns. After a breakout, you can project the length of the initial move to estimate how far the next move might go. By combining this projection with volume analysis, you can gauge whether there is sufficient interest to drive the price to those levels. Always remember that breakout moves should be confirmed by an increase in volume, as low volume breakouts are more prone to failure. Another useful pattern is the asterisk ascending and descending triangle asterisk. These patterns occur when the price makes higher lows or lower highs, respectively, while facing a horizontal support or resistance. When combined with the volume profile, you can identify high volume nodes along the horizontal level, which tells you that a lot of trading interest is present at that price. If the price breaks out of the triangle, especially with strong volume through a low volume node, it often leads to a continuation of the trend. Lastly, we have the asterisk wedge patterns asterisk. These are patterns where the price movement gets tighter over time, forming a wedge shape. With a rising wedge, you will often see decreasing volume, indicating that momentum is slowing. If the price breaks below the wedge and moves through a low volume node, it can lead to a strong downtrend. For a falling wedge, the price consolidates downward, and when it breaks out upward, especially through a low volume node, it often starts a strong uptrend. Using these chart patterns along with the volume profile gives you a clearer picture of what is happening in the market. You can spot potential reversals, breakouts, or continuations with greater confidence. Make sure to pay close attention to the high volume and low volume nodes as they align with these patterns, and use this information to make better trading decisions. Alright, let us start by setting up the volume profile indicator in RTrader Pro. It is easier than you might think. First, open RTrader Pro and load the chart you want to analyze. Next, go to the Indicators menu, find the Volume Profile indicator, and apply it to your chart. You will see the volume bars appear along the price axis of your chart. These bars are important because they are showing you where trading volume has been the heaviest. Now, once you have applied the Volume Profile indicator, take note of the volume bars distribution along the price levels. You may notice clusters of high volume at certain levels, which can give you insights into potential support and resistance zones. These clusters are referred to as high volume nodes and are critical for understanding market sentiment. After applying the indicator, you can begin customizing it. Adjust the time range to match your trading horizon. You can choose whether you want to analyze a single day, a week, or even months of data. The time range you select should reflect your trading strategy. If you are an intraday trader, focus on shorter time frames such as 1 to 5 days. For swing or position traders, consider using longer time frames such as a month or more. You also need to determine the look-back period. This setting defines how much historical data the volume profile will analyze. If you are analyzing recent trends, use a shorter look-back period. However, for a broader perspective that captures major price levels, use a longer look-back period. Additionally, you can adjust the precision of the volume bars. This means you can make the volume bars show more granular details or smooth out the bars to see broader trends. Finally, make sure to use settings that match your trading style. If you are day trading, you will want a more detailed and precise view, so using a short time range and high precision is ideal. On the other hand, if you like holding positions for longer periods, a broader look-back period and less precision can help you identify major trends and important levels without getting lost in the noise of smaller price fluctuations. Let us take a closer look at the main parts of the volume profile. This is important, so follow along. First, there is something called the point of control. This is just a fancy way of saying the price level where the most trading happened. Imagine this as the most popular price, where the most buyers and sellers agreed to do business. This price level often ends up being a really strong support or resistance level, simply because so many people are paying attention to it. Now we have what is called the value area. This is the range where most of the trading took place, about 70% of it. Think of this as the zone that represents a fair value for buyers and sellers. If the price is moving around in this area, it is like the market is comfortable. When prices go above or below this zone, that is when things start to get interesting. Next, let us talk about the value area high and the value area low. These are the edges of that value area. The value area high is the upper boundary, and the value area low is the lower boundary. These points are really important because if the price breaks above the value area high or below the value area low, it can be a sign of a new move starting. Sometimes a break above or below can mean a trend is picking up, so keep an eye on those boundaries. Now let us get into how to actually read this indicator. The volume profile has something called high volume nodes. These are areas where a lot of trading happened, and they often work as support or resistance levels. Think of high volume nodes as zones where the price might slow down or reverse. If the price comes back to one of these high volume areas, it will often pause or even bounce off these levels. On the other hand, we have low volume nodes. These are price levels where not much trading has taken place. Price tends to move really quickly through these areas because there is not a lot of resistance. Think of it like a road with no traffic. The price can move fast through these levels. This can give us good opportunities for breakout trades where the price makes a quick move without much resistance. So how can we use the volume profile for support and resistance? The answer is pretty straightforward. When the price is dropping and hits a high volume area, it might act as support and bounce back up. Similarly, if the price is climbing and hits a high volume node, it can act as resistance, causing the price to reverse or pause for a while. Understanding this concept is key to using this tool effectively. All right, let us get into some trading strategies. These are practical ways you can use what we just talked about. The first strategy is trading with the point of control. If the price is testing the point of control during an uptrend, that is often a good opportunity to buy. If the market is going down and it hits the point of control, it could be a good time to sell or go short. The idea here is to use the most traded price as a point where the market might make a move. The next strategy is called breakout trading. This one is exciting. Keep an eye on when the price breaks above the value area high or below the value area low. When a breakout like this happens with strong volume, it can mean a new trend is starting. If the price breaks out, you can enter a trade in that direction and ride the trend for as long as it holds. Another strategy is trading reversals at low volume nodes. Because price tends to move quickly through low volume areas, these spots can lead to fast reversals. If the price hits a low volume area and starts reversing, it might move back to the nearest high volume node. This gives you a chance to enter a trade and capture the reversal. You might be wondering how to make your analysis even stronger. The key is to combine the volume profile with other indicators. Moving averages can be really helpful here. For example, if the price is above a moving average and near the value area high, that makes it a stronger signal to buy. You can also use the relative strength index to spot overbought or oversold conditions. Let us say the price is near the value area low and the relative strength index is showing oversold. That could be a really good time to buy. Another great tool is the moving average convergence divergence, also known as the MACD. If the price is moving out of a low volume node and the MACD is showing momentum picking up, that strengthens the signal for a breakout. All right, now let us talk about risk management, which is super important. When you are trading with the volume profile, you can manage risk by placing stop losses near key volume levels. For instance, if you are buying, you might place a stop loss just below the point of control or the value area low. This way, if the market moves against you, your losses are kept in check. You should also think about adjusting your position size depending on the volume levels. When trading near high volume nodes, you can take larger positions because those areas tend to provide strong support or resistance. Let us expand on how different chart patterns interact with risk management using the volume profile. For example, in an ** head and shoulders ** pattern, you might set your stop loss just above the right shoulder when you expect a downward move, especially if there is a low volume node near, by signaling potential for a quick decline. Similarly, when trading a ** double top ** pattern, placing a stop loss just above the second top makes sense, particularly if the volume profile shows reduced interest above that level, suggesting a high probability of reversal. In ***, ascending and descending triangles ***, you should consider setting your stop losses beyond the high volume nodes that define the base of the triangle. This ensures that if the breakout fails, your losses are limited. For ***, wedge patterns ***, stop losses should be placed outside the wedge boundary, preferably below a high volume node for rising wedges and above one for falling wedges. This way, you are managing your risk in alignment with the market structure and volume interest. When it comes to ***, flags and pennants ***, the consolidation phase tends to have lower volume, and it is best to place stop losses just outside the flag or pennant structure. This placement should be near a low volume node, as a breakout through this level could indicate a shift in market dynamics. Risk management with chart patterns and volume profile requires a combination of understanding both the pattern itself and the underlying volume activity. Always aim to place stop losses at logical levels that align with volume barriers, ensuring that if price moves against you, it indicates a significant shift rather than typical market noise. Before we wrap up, let us go over a few common mistakes to avoid. One big mistake is ignoring low volume nodes. These areas can be really significant because they can lead to quick moves. Always pay attention to these zones, as they can be where big opportunities come up. For example, low volume nodes often act as zones where price can break out or break down rapidly, giving you opportunities to capitalize on sudden moves. Another common mistake is ignoring the significance of ** chart patterns * combined with volume analysis. Understanding patterns like **, double tops, head and shoulders, flags, pennants, wedges, and triangles ** in the context of volume can make a big difference. If you see a pattern aligning with a high or low volume node, it can help you better predict the market's next move. Another mistake is not using the right time frame. If you are trading intraday, make sure you are looking at shorter time frames, such as 1-minute or 5-minute charts. Shorter time frames allow you to react quickly to changes. If you are holding positions longer, make sure you use weekly or even monthly profiles. These give you a broader perspective and help you understand the major price levels that are attracting or rejecting volume. Do not underestimate the importance of ** volume profile structure * in different market environments. For instance, during a ** trending market **, low volume nodes can act as pathways for fast price movement, while high volume nodes can create pauses or consolidations. In ** sideways markets **, high volume nodes are often areas of balance where buyers and sellers agree on fair value, leading to extended periods of price staying within that range. Identifying which environment you are in can help you avoid getting caught in losing trades. And finally, do not rely only on the volume profile. It is a powerful tool, but it works best when you combine it with other indicators for better confirmation. For example, using ** relative strength index RSI * can help determine whether a breakout or reversal is supported by momentum. ** moving averages * can also assist in identifying trend directions and help avoid taking trades against the major trend. Combining multiple tools together provides a more holistic view and can greatly improve your trading accuracy. So to recap, the volume profile indicator is a fantastic tool to help you see where the most trading volume has happened. These key price levels can act as support, resistance, or even as points for a breakout. To get started, all you have to do is apply the volume profile indicator in RTrader Pro. Watch for high volume areas for support and resistance, and keep an eye on low volume nodes for breakout opportunities. The volume profile indicator is one of those tools that, once you get the hang of it, can make a real difference in how you trade. It helps you find the spots that matter most to traders, and that means you can start finding better opportunities. Keep practicing, combine it with other tools, and soon you will start seeing the market in a new way. Feel free to ask questions and share your thoughts. It is always good to discuss and learn together. Good luck and happy trading.